Do you know what the riskiest part about investing is? I'll tell you. The riskiest part about investing is not investing. See, I can keep going on about how you don't need a lot of money to get started, just whatever dollars you can scrap out at the end of the week, just keep throwing into it. And I can keep teaching you about the stock market, the fundamentals, so that you're not just blindly throwing money into something you don't understand. But for a lot of people, they will still refuse to invest. And the reason is because they don't like risk. We as humans are risk adverse. We like certainty. We like safety. The thought that we can put our money into something and then overnight it might just all disappear is a very scary fact. I have conversations with my family about how they are just so convinced to their core that investing in the stock market is just not the right way to build your wealth because it's so risky. But what I need to make clear in this video is that we're not gambling here. We're not putting all our money on red and hoping it hits. We're not buying some fancy new crypto coin hoping it takes us to the moon. What I'm going to be talking about in this video are real strategies that will help you not become a millionaire overnight and not make you lose all your money overnight, but will slowly build your wealth over time at the same time minimizing all the downside. Welcome to Finance for Everyday People. I'm Jeff Mora, where I teach you all about your personal finances like you should have been taught. So let's talk about risk, because it's unavoidable, but there are some easy ways to manage it. So when you buy a stock of a company, one of two things is going to happen. Either the company succeeds and that stock price rises, or the company struggles and the price of the stock falls. So how do we reduce this risk? The answer is diversification. Let's start with a fun example. Let's say it's Halloween and you only have $20 to spend on Halloween candy to leave out for the trick-or-treaters at night. You go to the supermarket, to the candy aisle, and you see that there's a big bag of chocolate bars, a big bag of peanut butter cups, and a big bag of gummies. Now, each costs $20, so you're not quite sure what you should get. What if the kids hate chocolate? What if people are allergic to peanut butter? What if gummies are just the hot pick this year? Instead of scratching your head and wondering what to buy, you walk further down the aisle and see that there's a variety pack that includes all three. Some kids like chocolate, some like peanut butter, some like gummies. But you'll be protected no matter what becomes popular. See, the thing about diversification is that it won't guarantee success, but it protects you from being completely wrong. And so we want to apply the same logic when it comes to stocks. You could buy just Apple stock, you could buy just Tesla stock. It could work, or it could fail. And so now we ask ourselves, can we buy the variety pack when it comes to stocks? Before we can answer that question, let me introduce to you what an index is. So an index is a collection of investments used as a benchmark to measure performance. Before funds existed, people wanted to know, how is the stock market doing? But there are thousands of stocks. So indexes were created as scoreboards. Let's say it's 100 years ago and I have my money invested into a bunch of oil companies. And after a year, I did pretty well. I have a 10% return. So these indexes act as scoreboards so that I can compare however I did to the general market. See, if I was invested in oil, then I would look to see how the other hundreds, thousands of energy companies performed. I would look for an index specific to the energy market. If I was invested in one or two tech companies, then I would like to see some sort of index that tracks all the tech companies, the tech market, to see if I just happen to have a good year with the two companies I bought into, or if the tech market filled with thousands of other companies just happened to have a good year as well. And then one day, someone had a brilliant idea. Instead of trying to compare yourself against the scoreboard and outperform it, why don't we just invest into the scoreboard itself? And I literally mean buying a piece of all the companies that are tracked in that scoreboard, or rather index. Hence, the index fund was born. See, the index is a shopping list. The index fund buys everything on that shopping list. So instead of buying one or two companies, what if I told you can buy a piece of the top 500 companies in the US? And this is what we call the S&P 500. This index tracks the top 500 or so companies within the US. And so funds revolving around the S&P 500, index funds, are what people buy when they want a piece of those 500 companies. This is the variety pack we've been looking for. Now that we know what an index fund is, the question remains, how do we get one? There's a couple answers to that. The first is through an exchange traded fund, or an ETF. The power behind ETFs is that they trade just like stocks would. So instead of having to buy individual stocks, you can just trade ETFs that contain a piece of whatever index it's tracking. I do need to mention that ETFs are just one way to buy index funds, but you can also buy them through mutual funds. And I'm not going to dive too deep into this subject, but these are more traditional and nuanced, whereas ETFs are very flexible and popular in today's modern age. So going back to our candy example, we can think of an index as like a list of chocolate bars that we're interested in. The index fund is the variety pack that contains all those chocolate bars. And then finally, the ETF is the place we go to buy that variety pack. Because Walmart has their own version of the variety pack they sell. Target has their own version of this chocolate variety pack. CVS has even another version. So whether I choose to get Walmart's version, Target's version, or CVS's version, the main idea is that it's the same type of chocolate being sold, and that's the index fund. In my last video, I talked about how you can buy a stock that on average gets you 10% returns. And that's very true when it comes to these SP 500 index funds. You can buy ETFs that trade like everyday stocks, hold on to them, and again, on average, they get you 10% gains every year. Another thing to keep in mind is that these variety packs don't come for free. You might notice yourself when you go to buy candy that the variety pack is slightly more expensive than the big bag of just one single candy. And this is true when it comes to ETFs and index funds. See, an index fund is actually pretty cheap compared to other funds because it tracks an index. These are already established lists that don't need to be altered. The alternative is buying a fund that's actively managed by a fund manager, which is just someone who claims that they can do better than the index that you're trying to track. Sometimes they do, but for the most part, they don't. You can think of it as like you're hosting a party, and you can either have a DJ come in for $200 and he swears to you that he'll play the best music ever and everyone will love it. Or you can go with a really cheap option and just stream the Billboard Top 100. You can see the difference between tracking an index like the top 100 songs for a very low cost versus having someone claim that they can just do better. Funds like that, which are more unique, will cost you a lot more. I'll wrap it up here, but in my next video, I'll talk more about other indexes you should be interested in and the ETFs that wrap around them. I talked a lot about the S&P 500 in this video because that really is a great example that most investors buy into because it's just proven over and over again that it successfully builds your wealth over time. But there are other indexes and ETFs wrapped around them that can also help you build your wealth. But until then, I hope you enjoyed this video. I'll see you next time.